All right, good afternoon, everybody. Welcome to McQueen Financial's webinar. It's going to be covering Investments 101. And I want to also spend a little bit of just a couple moments just to talk about McQueen Financial Advisors. We're a national provider of a variety of services to financial institutions across the country. It encompasses our ALM services, with all the related reports go along with it, CECL reporting, as well as investment advisory for banks and credit unions. And then we have some other subsidiaries for non-for-profit asset management, as well as some boutique high net worth individual asset management as well through our Integrity Investment Management Group. Joining us today, we have two of our advisors here, which I'll introduce. Myself, I am Craig Cecilia, our Chief Investment Officer. I work with clients across the country working on investment portfolio management, overseeing credit, and so forth. And we have one of our senior advisors, Alicia Bradley. She works with financial institutions across the country and works on asset liability management, as well as investment portfolio management, and does work with boards as well as management on strategic issues and planning, and also does a lot of good work with all of our new advisors as they come in and help with their training. Another advisor joining us as well is Zach Brown. In addition to playing the guitar very well, he is also a fabulous advisor. He works with banks and credit unions across the country and works on ALM issues, as well as coaching of management for strategic purposes on how they're going to plan out their year and budgeting. So thank you both, Alicia and Zach, for joining us today.
Yeah, thanks for having us.
You're very welcome. I'm excited to hear all the good news. This is an Investment 101 webinar, so I want to just let everybody know on the webinar. And if you do want to have a copy of this, it will be posted to our website. We have all of our past webinars on there, and we have what we call as a YouTube channel, and it goes to the McQueen YouTube channels, and you can see all of our past webinars for training. It's a great way to not only look at it again for yourself, but also to share with staff or somebody that may be new to the department just trying to learn on the investments world. So with further ado, I'm going to kick it off. I'll hand it off to Alicia, who's going to go do an overview and give the kickoff. Oh, one thing, Alicia, excuse me for
Yeah.
1 sec. We have in the chat function, or I'm sorry, and there's a Q&A button for all of our webinar participants. If you'd like to ask a question, please throw it into the Q&A. We'll be monitoring that throughout the presentation. And if there's something that's appropriate for the content right there, we'll interrupt and answer the question. If it's something that can wait to the end, we'll do that as well. So at any point in time, just put it there and we'll be monitoring for you. So please welcome, all questions are welcome. All right, thanks again. And Alicia, off to you.
Perfect. Thank you so much for the introduction. So a brief overview of what Zach and I are going to talk about today. Mr. Brown is going to kick us off with an economic update. We'll filter from there to portfolio strategy. We'll talk a bit about asset class diversification. We'll go through policy, which is going to take up a big portion of the webinar today, an overview of the trading process, and then the importance of documentation. So Mr. Brown, take us away with our economic update.
All righty. So we have a few charts here, and they're all going to kind of paint a similar picture on the economy. The first one, there's the yield curve. What we're looking at is an inverted yield curve. So the short-term rates are higher than the long-term rates. And essentially, you're compensated more for investing short-term. Reason for that is because there's more demand for long-term investing. Investors are expecting rates to come down in the future. So they're going out and purchasing these long-term bond yields, pushing those yields down. So it's really just a function of supply and demand there. We've been in this inverted yield curve for quite some time. I think it's coming on 2 years, which is pretty crazy. But where we go from here completely depends on market data and how effective the Fed is at reducing inflation at the end of the day. So the second one we have is, so in this chart, what we're doing is we're plotting out the Fed funds rate, that red line, and we have the 10-year treasury and the 2-year treasury. But I always like to point attention to the red line and the blue line, the Fed in the 2-year, and the correlation between the two. You can see the two have closely followed each other in the past. And essentially what this is showing us is the market versus the Fed. The Fed is in control of that red line and the market controls that 2-year treasury. And right now the market's trying to get ahead of the Fed as they usually do and predict where rates are going to go. So right now you have the 2-year treasuries below that Fed funds rate, which is a good indication that the market is anticipating rates to fall down in the future. And they've been pretty accurate in predicting that in the past. As you can see, going back to 2006, 2018, when we've been in this environment in the past, you can see what has happened next. The Fed funds rate has dropped. So they've been pretty impressively accurate in predicting when that was going to happen. So the next chart really feeds off of that. And we have the FOMC meeting dates and implied rates. So what we're looking at here is the market's expectations for rates in each of the upcoming FOMC meetings. Right now, we're in that 525 to 550 range. You can see the first time that changes is in June. So that's indicating that the market is anticipating that first cut to happen in June. And they have 2 additional cuts occurring that year as well, one in September and then another at the end of the year. So I always say this forecast changes all the time, like my wife's mood. It's very up and down. Depends on recent data and the headlines. If you look at,
excuse me, I don't know if she's going to appreciate that or not.
she could probably hear me. It's okay.
Okay.
She understands the relationship.
Understood.
Yeah. So right now we're actually trending to 2 cuts. And last month we were looking at 7 cuts. So that gives you any indication of how up and down it is. So overall, we're a big fan of looking at trends rather than reacting to the latest data set. And the trends are pointing in the positive direction to expect cuts at some point with inflation falling. So from there, we're actually going to get into the meat of it with portfolio strategy. And Alicia, why is it important to have a strategy when investing?
There are several reasons why we have an investment portfolio. And to have that strategy is important because it helps dictates how the portfolio is put together. It kind of gives us part of our why. So there's several bullet points listed here, just some reasons or some options as to why we have strategy. The first 2 go hand in hand, lending and cash flow. The cash flow that comes out of the investment portfolio can be used to fund the lending needs of your institution. Cash flow and liquidity, the second and third one, go hand in hand as well, because the cash flow coming out of the investment portfolio, if it isn't used for lending, can either be added back to the liquidity position, reinvested within the portfolio, or given the recent liquidity issues we've challenged or faced, offsetting some of the deposit outflow that we've seen. That fourth one there, minimum percentage of assets, it's the least common one that we see. Some institutions do have it stated in their policy that their investment portfolio has to be a minimum percentage of assets. Typically, when I see it, it's anywhere between 2 and 5%. Again, it's not incredibly common, but it is something that we see from time to time. And then that last bullet point there is earnings. For institutions who have a very small or very low loan to deposit ratio, the investment portfolio is a stronger source of earnings because they don't have the loans on their balance sheet, and the net interest income then supplements the earnings of the institution. Mr. Cecilia has a question.
So, no, well, thank you. I appreciate that. We did have a question that came in,
Okay.
and it's very relevant for the slide. So instead of waiting
Yeah.
till the end, we're going to bring it in. And it has to do actually something you mentioned, Alicia, which is very interesting, I think, as well. And the person asking the question is saying, since we've had the issue with the last round of bank failures, the SVB, has the mindset of either the regulators or just an average in the industry changed the amount of liquidity that people want to have on hand from that 3 to 5, or has it been kind of steady?
I don't think from a regulatory perspective it has changed. I know that you would like the number to be 0 or maybe 1. We then tell you no, it needs to be 3 to 5. For a lot of my clients, I'm still erring on the side of caution of 5 to 8%.
Okay.
We're starting to see some of that liquidity build up. but we're all a little still concerned about where is it coming from and where is it going to go.
Right.
So I'm still more comfortable in that 5 to 8% camp. 10% is probably too much across the board. But there was a harsh come down on, was it liquid cash or 1 year cash to ask for short-term cash to assets in
Mhm.
the last round of exam cycles. So having that little bit of excess cash is not necessarily a bad thing right now.
Gotcha. Yeah, great answer there. Thank you.
You're very welcome. I'm going to let Mr. Brown take the next slide and talk about how we put that strategy together.
Yeah, when it comes to portfolio strategy, we like to focus on safety, liquidity, and yield, and it's listed in that order. Safety being the most important at the top there. We don't want to chase yield. You could get burnt doing that. So the goal is to mitigate that risk, not completely get rid of it, just to manage it. So we have some of the risks listed there. We have principal risk. So essentially, like the name suggests, it's the risk of losing principal. Key there is not being overly concentrated in bonds with credit risks like municipal bonds and corporate bonds. And then premium risk. So buying a bond at a premium, you want to pay attention to the amount in excess of par that you're buying and how you're amortizing that over the life of the bond. From there, we have liquidity. That one feels especially important in today's environment, right? As financial institutions, we want to have reliable and predictable cash flow to match up with our liabilities. Cash flow can depend a lot. It can change a lot depending on the type of security you're investing in. On one hand, you have these amortizing securities, you have mortgage-backed securities. They're going to provide steady cash flow, but very highly sensitive to interest rate movements. So any fluctuations in rates can affect the amount of cash flow you're receiving from those bonds. And on the other hand, you have bonds with static maturities. So like a CD or a bullet agency, they have a stated maturity date, and then they pay principal all at maturity. Those guys are a little nice to have in this for predictable cash flow in this environment. Pledging for line of credit. So having security that that serves two purposes that you can use for income and use against borrowings is always nice. You have treasuries and agencies. Those are the two most common that you see for pledgeability. And then yield, finally. So that's also very important. We all want to increase our earnings. When looking at yield, it's really important to pay attention to that coupon rate. Is it fixed? Is it variable? And modify your strategy accordingly. Right now? It's a good time to lock in these fixed rates with the expectation that rates are going to fall, and optionality. So that's something you typically want to avoid in this environment. If you're anticipating rates to fall, you don't want to buy a bond with a call and then have it be called a year from now and you have to reinvest into lower rates. So those are some things to watch out for. But overall, when looking for investments, you want to look for investments that are safe, predictable, reliable for liquidity, and then income generating as well. So the next slide we have, we're going to get into the basics. So Alicia, what is a bond?
Well, per Investopedia, the legal definition of a bond is a fixed income investment that represents a loan made by an investor to a borrower. It tells us what it is, but it doesn't give us any explanation as to what it really is. So we know that it is a security or a holding, but when we're looking at those things, there are some basic pieces to it. So we want to look at our par amount. The par amount is the amount of the bond that we're going to purchase. Typically in a fixed income portfolio, par is considered 100. So anything price-wise above 100 would be considered purchased at a premium. Anything below 100 would be considered at a discount. We want to look at our coupon. Is it fixed? Is it variable? Does it float? And what is that coupon in comparison to today's market? Are we looking at a higher coupon security or a lower coupon security? And additionally, that coupon, when we multiply that number times our par amount, that is what we will receive as an interest payment. And then any sort of premium or discount will offset us to get us to our final yield. And then the maturity date. We always have a final stated maturity on almost every bond. There's some bonds out there that are perpetual. But that maturity, so then is that bond callable? Is there any sort of optionality to it? Is it the chance that it could potentially get called away sooner, that prior maturity? So knowing how much we're going to purchase, what that coupon is, and that maturity are all incredibly important when we look at each of those bonds.
So we have another question that actually came in on here, and that is a fabulous question as well.
Yeah.
When looking at a bond, does the person look at this par coupon and maturity, and will the expectations that it'll always be fixed that way, or could any one of these, you mentioned about the coupon could be fixed or variable, but will the par, will the maturity change based on what's going on? But for most stuff, will it stay the same?
It depends on the type of bond you buy. For most bonds, the par amount will stay the same. If we're looking at an amortizing bond, the par amount will change over time. A bond with a static maturity will receive all of the principal back at its final stated maturity. A bond that amortizes is going to receive principal payments on an ongoing basis. So when you get to that final stated maturity, you only have one or two principal payments left that need to be accommodated. And in regards to the coupon, it also depends on the type of bond. There are some amortizing commercial mortgage-backed securities where the coupon on them changes as the loans filter or pay down out of the bond itself. It's not very common in that space, but we do see it. And if the bond is variable, it means that the coupon on that bond is going to be tied to another interest rate of some sorts. It may be SOFR. It could be, in the past, it would have been LIBOR. And it will float at your stated rate, whatever it may be, 3 months SOFR, one year SOFR, plus a spread. And as that SOFR amount changes, your coupon rate is then subject to change as well.
Gotcha. Thank you for that, Alicia. So it sounds like you can choose one that has a lot of uncertainties and some that would definitely be certain you know exactly what's going to be. It just really depends on what you're buying at the time.
Absolutely. You can buy a
Okay.
basic vanilla ice cream cone, or you can buy a chocolate dip with sprinkles and a cherry on top.
Good analogy.
Looking forward to that warmer weather. So then from there, we get into asset class diversification. And I'm going to let Zach talk about why it's so important that we have that diversification.
Yeah. So it's really important to diversify your assets in order to maximize the value in your portfolio. And what I mean by value is the yield of the security compared to other investments with similar terms or average lives. So in addition to that risk profile, it's also something really important to look at as well. I'll give you an example. You have two options. You can go out and buy a 3-year CD yielding 5%, or you can buy a 3-year single A rated corporate bond yielding 5.2%. What looks better? The corporate bond looks better from a yield standpoint, but the CD has an argument because it has no credit risk. So from a value standpoint, the CD might be better. So overall, you want to maximize your earnings by adding some degree of credit risk with some corporate bonds, municipal bonds. But you also want to balance things out and diversify assets as well to maximize that value. So I mentioned corporate bonds and CDs. We're going to talk a little bit more about that on the next couple of slides, but we have some other ones we want to discuss as well. So Alicia, what are some other asset classes you should consider when investing?
So we have several different asset classes that we look at when looking for bonds for the investment portfolio. The first very basic vanilla one, so this is your vanilla ice cream cone here, treasury bills and treasury notes. A treasury bill is a short-term security. So maturity is 12 months or less. They do not have coupons on them, meaning you are going to buy that bond at a discounted rate, and you are going to receive par back at the maturity date. Your treasury note is going to be anything longer than that. So whatever the coupon is on your treasury note, you will receive on a semi-annual basis. The next one is agency bonds. We typically look most commonly for agency bullets. Both the treasury bills and notes and all of the agency paper are all pledgeable. We look at those agency bullets. They are typically issued by Fannie Mae, Freddie Mac, Farmer Mac, TVA. There's a couple of other names in there as well. They have a set coupon. They have a final stated maturity. They are very vanilla. We can introduce some optionality into those as well by looking at callable bonds, meaning that that bond is going to have a stated call date, and then it will be callable from then on out. The features of how often it will be callable will be bond dependent. It can be anywhere between a one-time call, meaning that the bond can only be called on one specific date, to the bond is callable in 6 months and then it's callable continuously until its maturity date. Just depends on how the agency issuing that bond structured it. And then we also have step bonds. in which the coupon on the bond will change at each step date. Typically at that step date, those bonds are callable as well. And we typically see those steps in terms of the coupon is moving upwards in each one of those steps. And then when you look at the overall yield, you look at the blended rate of how long you're going to receiving those coupons for each one of those terms. And then the bottom two are a little less vanilla. We have MBS and CMO, so mortgage-backed securities and collateralized mortgage obligations. Both of those are backed by residential mortgages. There are a couple of different kinds. They're government-backed, so those are going to be Fannie Mae, Freddie Mac, and Ginnie Mae. And then we also have private label MBS and CMO that is in a space that we dabble into often. It tends to be a little trickier just from a modeling standpoint and a credit rating standpoint as well. And then CMBS, which is commercial mortgage-backed securities. So those are also going to be amortizing mortgage products, except they will be backed by commercial loans and commercial properties instead. These are going to be things like our Fannie Mae DUS, Freddie K, and our Ginnie Mae project loans.
Thank you, Alicia. Very, very good information there. We did have actually one question that came in on the previous slide that's
Yeah.
extremely relevant to this slide, actually, because one of the things we mentioned you were talking about was when describing a bond was talked a little bit about factoring or pay downs. And the question was, could you just expand on that a little bit? Keeping in mind this is a 101,
Yes.
but just expand a little, for most people, but expand on what that factoring is on a mortgage-backed security or
Yeah.
CMO.
So, so I'm going to create an example bond to do this because it'll be the best way to explain it. So we have a mortgage pool that we're looking at. It has 10 loans in it. And each one of those loans is $100,000. So the par amount on the pool is $1 million. And we as a firm are going to buy the whole bond. So we go through, everybody makes their principal payments the first month, and that factor is going to come down from 1. Let's everybody's loan payment's about $100. The factor is going to come down from 1 to 0.99. So we have 99% of the principal remaining on the bond. Well, next month, Craig decides he doesn't like this house anymore, and he's going to sell it, and he's going to move, and he's going to go buy another house. So he is going to sell his house, and when he sells his house, his loan will come out of the loan pool, and it will come out of that bond. So when Craig pays his loan, which instead of $100,000 now is $9,990, it's going to take all of that principal and it's going to apply it to the coupon or to the factor, excuse me, because the principal amount outstanding on the bond is no longer $1 million. We're now just shy of 900,000. We're going to be 800,999 something. So our new factor is going to be 0.89. The factor is the amount of principal outstanding compared to the original amount of principal purchased. And we look at it as the bond overall, not necessarily what we own as a percentage of the pool itself.
Okay, yes, very interesting actually. And I think you mentioned it's not as, plain vanilla type of
Yes,
security. So
it's
you
not.
really, you have people that are just solely dedicated to investing in mortgages and
Yes.
CMOs and CMS. So great explanation. Hopefully that answered the question, but it surely did sound like it did. So nice.
Yeah.
Thank you.
All right, and then I'm going to let Mr. Brown take the asset classes on the next slide here. Not quite as complicated as mortgages and CMOs, and typically no factoring involved.
A little easier. CDs are a little easier than mortgages, right?
Yes.
Yeah, I would say so too. CDs, everyone's familiar with a CD, certificate of a deposit at a financial institution. They're one of the better asset classes right now in the short term for one main reason. The biggest reason is that banks need liquidity. So they're going out and paying a premium to attract deposits in. So they're a very solid asset class when it comes to value in the short term. But they start to lose that value once you go out longer than 3 years. Because the reason why is because no one wants to issue long-term funding right now at these high rates. So beyond 3 years, you kind of have to get creative, and that's where corporate bonds and municipal bonds come into play. You start to see great value in that space when you get beyond 3 years. But with those asset classes, you're starting to introduce credit risk as well. So that's the risk that you could potentially lose principal if the issuer fails. So it's pretty significant. With that added risk, you're also compensated more. So they're definitely worth exploring. You just have to understand the risk and the different structures associated with the different types of asset classes. When looking at anything with credit, you need to make sure you're looking at reviewing the credit of the issuer, which is something we actually do at McQueen. We have a credit team in-house and we review every single issuer before we purchase it and on an ongoing basis as well. So it's very important to do that. And then with municipal bonds, there's another layer of complexity there because they're just different structures. If you're a bank, you can actually purchase a bank qualified tax exempt muni, and those offer tax advantages. They don't offer those to them to credit unions, but if you're a bank, they're applicable to you. We have an example there, that little chart. The yields are just hypothetical. You can see taxable and a BQ tax exempt muni, and then the yields. And you can see the yields are they always are typically lower on the BQs compared to taxables. But with that added tax benefit, the earnings are higher. So you can see the earnings on the tax equivalent yield after factoring in that benefit is basically the same as that taxable. And in some cases, it might even be higher. Just depends on the municipal bond. So once again, both municipal bonds, corporates, great asset classes to sprinkle in to your portfolio. Just need to understand the risks before getting into them. So Alicia, before you start investing, I think it's pretty important to have a policy, right? Is that fundamental?
Just a little bit. Just a little bit. And then that policy in and of itself, it's going to cover a lot of items. It should be a little longer than a page or two. So everything that Zach and I cover in this policy section is pertinent to both FDIC and NCUA regs. So regardless of which side of the fence you're on, these are all items that should be included in your investment policy. Traditionally, the investment policy is written by management and then it's approved by the board of directors. It does state on there it should be reviewed annually. So even if there are 0 changes within the investment policy, it should still go to the board on an annual basis so that date can get updated, so that regulators and examiners know that your board is aware of the fact that the policy is in place and that there are no changes if there are none, or acknowledge that there are changes and notate them appropriately. So the first thing, most policies open with a purpose and an objective. So they state the why and how we have the policy. What is the goal of the policy, and how is it going to serve? We have our corporate governance section, which is going to cover who within the institution has the authority to make investment decisions on behalf of the financial institution. And then that third bullet point is incredibly important, the delegation of authority to a third party. We cannot purchase investments without approval from anybody within your institution. And then the policy allows us to go out, make those recommendations, and then make those purchases on behalf of your institution with the appropriate authority. So that ties directly back to that corporate governance section, is we at McQueen need to know who we are or are not allowed to take authority from in regards to the responses on our email recommendations. We have our authorized or unauthorized asset classes. So which asset classes are we allowed to purchase? Mr. Brown and I went through several of them in the previous slides. Not every policy allows for every single asset class, and we want to know which ones we can or cannot purchase. Sometimes it comes down to what is the risk profile of the institution in making those decisions as to which we can or cannot buy. Then we also want to have the limits for each of those asset classes as well. It can be as simple as what is the limit as a percentage of portfolio, or it can be a little more in depth, and we can look at what is the limit as a percentage of equity or net worth, and then what is the limit as a percentage of asset class. Those limits also encompass what the minimum credit rating is that we can purchase, whether it be from the McQueen credit rating standpoint or the larger S&P or Moody's rating. We also look at our weighted average lives as well as our final stated maturity date. And then we get into the approved broker dealers. Sometimes that list is attached to the policy. Sometimes it is included as an appendix. But nonetheless, there needs to be an approved broker dealer list that goes with each policy. And then there also needs to be a broker dealer selection and approval policy. We at McQueen have a broker dealer selection and approval policy, and our policy states that you guys will simply follow what we already do, and then that's provided to you guys separately. And then I don't want to say maybe most importantly, but that pre-purchase analysis. What sort of things are you going to look for pre-purchase wise in order to make the appropriate risk assessment on any sort of investment that we're looking to purchase? All of those pre-purchase analysis have several types of risks to them, and there are several risks within the policy itself. And I'm going to let Mr. Brown cover the risks that go along with the investment policy.
Yeah. So the first one there, interest rate risk. This one's pretty straightforward, but it's how does this security fit within our balance sheet and our risk profile? But make sure you're not buying an investment that's going to blow up your NAI or NEV sensitivity. Liquidity, marketability. So purchasing an investment that can or cannot be readily sold in the market. You have certain securities that are non-marketable, and it sets up a lot of liquidity risk. The couple examples, private placement, municipal bonds, and subordinated debt corporate bonds. Those guys are a little harder to sell. Some of them are non-tradable, right? So there's an added layer of risk with those. You have concentration risk, call risk, prepayment risk, and extension risk. So with these, they're all very related, right? And a good example that applies to all three is that if you do a lot of, if your bread and butter in the loan portfolio is mortgage loans, you probably don't want to do a lot of mortgage investments in the investment portfolio. You want to diversify into other asset classes because those guys are going to act in the same way. When rates fall, you're going to get a lot of cash from those, from both your investment and loan portfolio that you now have to reinvest into lower rates. That's very important, especially nowadays. And then credit risk down there. If we purchase a security that has credit risk, the policy states that we have to review the credit on an ongoing basis. Like I mentioned, that's something that we do here at McQueen with our portfolios. We have our own credit team and our rating system. We provide ratings in addition to Moody's and S&P ratings. So not done with policy just yet, unfortunately. We have one more slide there. And Alicia has a few more things she's going to discuss on the next page.
All right, as you turn that page, one question did come in. Where I think I just changed my page. Yes. All right. Oh, I think this is for you, Alicia. The question is you were addressing that the financial institution has the or must set limits across asset classes. Do they have carte blanche across all asset classes that are available in the investable world?
I think you're on mute.
I am unintentionally. There is one asset class that has a federal regulation for credit unions, and that is taxable municipal bonds. They're limited to 75% of a credit union's net worth. In regards to what is considered a appropriate level for everything else, part of that is going to depend on what other asset classes are in your portfolio. What are you allowing and what are you not allowing? If you have all of the asset classes that are allowable, then putting limits on some of them would be appropriate. If you are limited to buying treasuries and or CDs, then we want to make sure that we are 100% or 75% on both from a percentage of portfolio standpoint, and maybe not include limits as a percentage of equity and assets so that we don't get stuck not being able to purchase any bonds.
Okay. Yep, I like that. And I think, for both, so we have both banks and credit unions on the call. And the other thing is like addressing the equities and preferreds that are popular. And they're for traditional portfolios, they wouldn't be appropriate for credit unions unless they're in one of their alternative portfolios, right? A charitable donation account or employee benefit account or a foundation that they set up, as well as for banks, unless they were up at the bank holding company, if they have the holding company structure, or in one of their foundations as well. Yeah,
Correct. Yep.
so, okay, excellent. I think that really did answer that really well. Thank you. I apologize for the interruption
No,
on that
no
question.
apologies at all. So then the last slide here on policy, and I know I had mentioned in the beginning this was going to be the biggest piece to the presentation because there's a lot of things that go into that policy. The last slide here, that top bullet point, procedures for holdings that fall outside of policy. Whenever we make a recommendation in a purchase, that bond is always inside our policy restrictions, weighted average life, asset class, maturity date range, all of those sorts of things. But from time to time, either I've seen it happen where the portfolio shrinks down to a point where a single holding is larger than what the policy states it's allowed to be for no other reason than the fact that the portfolio has shrunken in size. Or sometimes things get downgraded. Sometimes they go through multiple downgrades, and then that item is considered outside of policy. So we just need to have a few sentences stating what we're going to do for bonds that may fall into that specific bucket. A conflicts of interest section stating very obviously that we will keep the conflicts of interest out of the investment portfolio. Employees of the institution will not trade directly with the brokers at our brokerage firms, that we will not trade directly with the brokers at those brokerage firms. Very straightforward. And then the last two go hand in hand somewhat. We have our safekeeping. So we need to lay out where we're going to safekeep each one of our individual securities. And it's simply a statement within there, usually a few bullet points of where we're going to hold those items. And then the classification for each one of those securities, when we purchase them, they're going to go into safekeeping with that classification. So 3 different types. We have AFS, which stands for available for sale, meaning that we can sell that bond at any given point in time for any reason that we so choose prior to maturity. We have HTM, or held to maturity. Held to maturity bonds do have some reasons in which they can be sold. Not going to get into it here in Investments 101, but typically on a held to maturity bond, the intent is that you will hold that bond to maturity. There's no way to get out of it without tainting the portfolio. And then third classification is trading, which is prohibited by most policies. That means that you are going to purchase the bond and you have the intent to trade it within the next 30 days, presumably at a higher price, and take the gain on sale that comes with the sale of that security. So that wraps us up on policy. So ironically, as trading is the last bullet point, not similar to what's next, but I'm going to have Mr. Brown talk a little bit about the actual trading process and what we go through when we're looking for securities.
Right. Different type of trading. So when you are, you have a couple different options when it comes to purchasing an investment. You can either work with an investment advisor like McQueen, or you can work directly with a broker. And there's 2 separate markets that you can transact on. There's the primary market, so anything that's new issue, so when a bond is initially brought to market. And then the secondary market, which is you purchase those bonds, you sell them a year later, now they're trading on the secondary market. So bonds that are trading on the secondary market, the pricing is dictated by market conditions. They are trading at that prevailing market price depending on supply and demand there. And they're also dictated by dealers. The broker is going to buy it from you, they're going to mark the price up, and then they're going to resell it to make a profit. That markup can change a lot broker to broker. We've seen massive differences between 2 different brokers and their pricing, which sets up a lot of pricing risks. You really have to pay attention to that markup. If you're only working with one broker, you're more than likely leaving a lot of money on the table. So very important to look at multiple sources when going to transact. And then you get down into broker dealer. The biggest difference between a broker and how we operate at McQueen as an IA is, one, we don't take inventory on bonds and mark the prices up. We actually work directly with brokers and we pin them up against each other to see who has the best possible price. And then we execute at the cheapest price to save you money. And we have an example of that in the next slide. And then the second difference is how the bonds are delivered. So when we purchase a bond for you, it'll be delivered via DVP, delivery versus payment. And what that means is that when the broker receives the funds, they're going to transfer the securities into your personal safekeeping account in one transaction, not at an account at the broker-dealer firm. So if you go down to the next slide, we have a cool example of how pricing works on the secondary market. So the hypothetical is that we are purchasing a mortgage-backed security for $2 million, and we have 3 separate broker bids there, and the total cost to the credit union or bank. You can see that the prices themselves aren't massively different, but when you're looking at the total cost and the cost differences, that high volume adds up into thousands of dollars in savings. This is just one transaction, not just think of it, let alone the whole year of transacting. It's a pretty big cost savings there by shopping around. That's a big reason why policy dictates you have to get 3 separate quotes from different brokers. At the end of the day, when you see a bond on the market, you don't want to execute it with the first broker you see. You want to shop around, and which is where we come in potentially. Our job is to be that cheap uncle and shop for discounts and save you money potentially with through diversifying with brokers.
I love that reference, the cheap uncle. It kind of makes me feel like myself all of a sudden.
We all have
Um,
one.
yeah, this is really great information because it can actually, as you mentioned, Zach, add up to a lot of money over a year. And you mentioned about having three, or the requirement of having three competitive offers if you're buying, or bids if you're not, if you're selling. Is it okay to get more than that?
Absolutely. The more is better, right? We have more options to compare to. This is only 3 brokers. Just imagine if you had 5 or more brokers on there and comparing their prices.
Yeah.
So that's something that we do. We don't just look at 3, we look at more, and we do the same thing on the selling side too. When you're going to sell a security, we'll get different prices, and we'll execute at the highest price to save you money in that way.
Yeah, good. Thank you, Zach.
Yeah, you're welcome. So, Alicia, before we buy a bond, what are some things that we typically look at?
Oh, we're going to look at a lot of things. So from a pre-purchase due diligence standpoint, in our email recommendation, we are going to explain to you why we like this specific bond. Does it fit the ladder that we're trying to build? Does it fit the purchase plan that we're trying to build? Is it offering the best yield for the term? Is it pledgeable? There's a variety of reasons. So we're always going to tell you why this security, and it will be documented there in the email. We're going to give you a general description of the bond. It'll include the name, coupon, maturity rating, yield, or excuse me, maturity date, yield. So you have the very basics of it, and then the characteristics that come within each of the bonds. So we have listed their optionality. Does it have a call feature? Is the bond callable? And if it is callable, when is it callable? And how often is that bond callable? Does it have any sort of extension risk? That'll typically come on our mortgage or CMBS products because the bonds have a final stated maturity with a weighted average life. So how does that weighted average life change as the market rates move up and or down and the bond experiences an increase in prepayments or a decrease in prepayments? If the bond is credit rated or credit related, what is the credit rating? Not only from S&P and Moody's, but the McQueen credit rating scale as well. And we will also provide a copy of our internal write-up with it. And then we have listed there that last one, price and yield, and then sensitivity. We don't often list the actual price for a bond unless the bond is being offered at par because it's a new issue. We'll oftentimes give the spread to the treasury that bond is being offered at and then the corresponding yield, simply because if the market moves from the time we send that recommendation to the time the client approves and then we execute, the price itself can change. And oftentimes it's not a big change, but it is subject to change. So we would rather spread it or give the client the spread and then what it's being spread to so that they can calculate the yield out. And then any sort of sensitivity factor, again, more common on our MBS and CMBS purchases. What is the devaluation of that bond in an up or down rate scenario? So we know what it looks like from an interest rate risk and or NEV perspective. And then that brings us to one of our last slides here. So in summary, investment strategies are going to differ from one institution to the next. A very small credit union, 100 million, is going to have a very different strategy than a very large credit union, maybe say over $1 billion. Investment class diversification is so important. It goes back to the old saying, don't put all your eggs in one basket. We want to make sure that investment portfolios have a variety of different asset classes because each of those asset classes is going to act slightly differently as the market moves in a different direction. Your investment policy should be specific enough to cover the requirements set forth, but broad enough to allow for some flexibility. It should be fairly black and white, but a little bit of gray isn't too bad. We want to make sure that we cover everything that it's necessary to be covered without leaving a lot of wiggle room. And then keep detailed records. For those of you who know me, know that I am a paper person. So whether you print out your email recommendation and you print out the trade ticket that's sent after the purchase, you either need to keep an electronic record of the email recommendation that we send to you along with the electronic trade ticket, or you need to print everything out and put it in an old school manila folder. So when you go through your exams, you have everything that you need to suffice for auditors, examiners, and regulators. Then Craig, do we have any final questions that came in?
Thank you. I had to find my unmute button there really quick. Speaking about old uncles. Uh, yes, there are actually a couple there. You guys did a great job, by the way, presenting and keeping it at a level that's really understandable and very detailed. So I appreciate that. There are several questions actually, and I hope we
Right.
have enough time for them. Looks like we do, and these are going to be helpful, I think, looking at them. You finished off at the end about strategy, so we'll start there and we'll work our way back on some of the questions that
Perfect.
came through. Um, there are a lot of strategies out there, and it does depend. But what is a good strategy for that you would like to talk about today, Alicia or Zach, or both of you?
Zach, you want to go ahead first?
Yeah. So I would say it really depends on your interest rate risk position. If you have a lot of risk and sensitivity there, you have some limitations on how far you can go out and invest. But overall, all things being equal, we like extending the ladder right now and taking advantage of long-term rates to lock them in. Kind of going back to the beginning, my when we were talking about the economic charts, investors are anticipating that rates are going to fall. So it's a good time to lock in those rates and extend the ladder. And then avoiding optionality, I think that's a key one. Callable securities, amortizing securities, just limit the amount in your portfolio. Because if you buy a callable and rates fall, like I said, you don't want to reinvest into lower rates. And then with a mortgage-backed security, you buy it right now at current coupons and rates fall. Same thing. You're getting the mortgages within the mortgage-backed security are they're going to refinance, which is going to push a lot of that cash to you, and you're going to have to reinvest it into lower rates. So really depends on your institution, but overall as a strategy, I would say going out and locking in longer term yields and building your ladder out.
You took the words right out of my mouth, Mr. Brown. You said everything I was going to say. We did actually look at our first mortgage this week, first mortgage in a long time that we seriously considered. And one of the things we looked at is what was the underlying coupon on the mortgages that made the pool up in and of itself. Because we didn't want anything in that 6.5 to 7.5% range, knowing that those prepayment speeds would be significantly higher. And the bond we ended up settling on was a 5.5, the weighted average coupon of the underlying paper. Talked about it with the client, and the client just isn't ready to go down that path yet. They're not ready to take on that negative convexity, as we call it, because we know that at one point in time, those mortgage rates are going to fall, and then we're going to have to reinvest those proceeds into a lower yielding security.
Excellent. Good answers. Thank you, both of you. I appreciate that a lot. Another question here has to do with something that really you both just touched upon, because throughout the presentation, both of you at certain points touched on convexity or optionality. And is there a certain percentage that somebody should, which means that people are using it, and I'm assuming we use it. Is there a certain percentage that's acceptable, or does it really depend?
I think it greatly depends. I have some clients who want zero callable bonds in their portfolio. I have others who would love if the whole portfolio were callable for the sole reason of they earn higher yield on that bond, even if it's for a shorter time frame. It really just depends on the client. Some of the callables we have been entertaining lately, though, have a one-time call option in an extended date, so 1 year out, 2 years out. But making sure that both the call date and the maturity date fit the client's ladder. So if the bond were to get called, it fits into their cash flow. And if the bond were to go, or if the bond were to go to maturity, it also fits into their cash flow. Doesn't happen often because we don't see a lot of one-time callables. But we have been looking at those for a couple of clients.
Yeah, I agree. It depends on the institution. But overall, I would say make sure you build your ladder out and make sure you're comfortable with where your ladder is, and then supplement with callables or mortgage-backed securities afterwards. I wouldn't rely on building a ladder with callables. We've seen it far too many times where institutions have had a high concentration in callables, and then their maturity ladder was thrown off when the call structure didn't go the way they were expecting.
Yeah. In that situation, their expectation of liquidity for whether they can plan and budget for that liquidity, it just kind of got thrown off. It almost seems like you both referenced they took that SLY principle, safety, liquidity, yield, and flipped it upside down, looking for yield first. And that's the demise of anybody, really. And
Absolutely.
honestly,
Good point.
almost
Yep.
like an SVB type thing, what they invested in. And so it is crucial for each institution. Thank you, guys. You mentioned a lot of credit today, right? There's credit, there's risk, and I
Yeah.
think about diversification. So one of the questions is credit risk in what asset classes besides, or besides corporates? Is there other asset classes that have credit risk?
Municipal bonds have credit risk. When we look at a municipal bond, it's going to have an S&P and Moody's rating, S&P or Moody's rating. It doesn't necessarily have to have both. It will always have a McQueen financial rating. And sometimes those bonds also have insurance on them. We're based in the great state of Michigan, so a lot of our school districts have, it's called QSBLF. Texas has what's called the PSF program. And it's like an insurance wrapper to the municipality that's issuing the debt. We don't want to rely on that insurance wrapper because it enhances the credit of the bond that we're looking at. We want to look at the actual underlying credit of the issuer themselves, and not that wrapper, because the wrapper acts like a little booster. It's the sprinkles on top of the ice cream.
And we all like sprinkles, absolutely. I like the colored ones, not the brown ones, to be honest
Yes.
with you. It's sort of just better. They look better too.
Colored jimmies.
I love it. Anything on that, Zach, or should I roll on to the next question?
Yeah. Corporate bonds, municipal bonds, and then one you probably don't play into very often, private label, mortgage-backed securities. They will have credit risk as well.
Okay.
Yeah, those are the three main ones I see that have credit risk. You need to be extra due diligent on.
Sure. Okay. Just a couple more questions. And I am working backwards in that presentation based on some of these coming in. You talked to Zach, I think it was you brought up a little bit in the CD market for the participants here eligible to invest in certificates deposits issued by peers or non-peers. How do those get insured separately than, say, a customer of their institution walking in the door and having insurance up to a certain limit? Is that different for us as an institution investing in CDs?
That's a great question. My understanding is no, it's not different. They're both insured by the NCUA. Both the member deposits and any CD you purchase are both insured by the NCUA.
Or the
Okay.
FDIC.
Yep. Yeah.
Okay. So the limits are the same. It's covered that way, but you can certainly get over that insurance limit. Anything over 250, it would be uninsured, correct?
Yeah. Yep. Anything below 250 is considered insured. We typically try to purchase a little less than 250 to account for interest payments. So 249 to leave a little bit of that insurance for accrued interest. If
Mhm.
that, if something happens to the bank before they make that interest payment, we want to make sure we're going to get our interest payment.
Okay.
So, yep. Beyond that, uninsured. There's credit
Excellent.
risk involved. That's another one that has credit risk beyond
Yeah.
when you get beyond that 250.
Right. Or in the banknote space, I would imagine as well.
Yep.
Yeah. Okay. All right, I want to keep going on just so we can get through these questions. Another one that came through, we touched on this a little bit earlier, Alicia, and maybe Zach, you want to just highlight a little bit in addition to what Alicia has told, or you both can. But what do you consider in this appropriate amount of liquidity levels as a percentage? And let's just go off of as a percentage of deposits total.
Yeah. So that's a great question. And it really depends on the institution. It really does. It depends on the institution and your lending pipeline. That's key. If you're anticipating a lot of higher volume to come in, higher volume of loans, maybe hold on to a little more. You're struggling with lending, maybe stay a little lighter. But thinking of it from cash to assets percentage, we typically like to stay between that 5 to 10% range. So depending on that information I mentioned, if you're expecting a lot of loan volume to increase, maybe hold on to a little more in that range. A little less if you're comfortable with where you're at and you're struggling with liquidity. But liquidity is very important in this environment. The last thing you want to do is rely on borrowings. because essentially you're not your yield will be negative, right? If you borrow to finance an investment. So that's
Yes.
key. Just making sure you're keeping a close eye on liquidity in your upcoming pipeline.
Yeah. In that same, and I had mentioned it earlier, normally we like that cash to assets level to be in the 3 to 5% range. But right now I'm steering a little more into that 5 to 8% range. We are starting to see some liquidity pick up. I don't know if I would call it necessarily excess at this point. We are hearing that lending is starting to slow down, especially if auto loans are bread and butter. It appears that everybody who needed an auto loan over the last couple of years has already gotten one. So the one thing we don't know for sure is that excess liquidity, quote unquote, excess. Is it an increase in deposits? Is it a decrease in lending? Is it a combination of all those things? And if it is an increase in deposits, how sticky are those deposits actually going to be? So I'm erring on the side of caution and asking my clients to hold just a little bit extra right now, just so we get through the next few months and see what's going to happen with lending and deposits.
Excellent. Great questions. Do I have time for one more question? Because there is one more out there.
I think so.
Yeah, send it over.
As long as it's not incredibly complicated.
Well, this is now going right back to the very beginning here is Zach, I think you introduced it talking about the economy. You talked about, the expectation of Fed funds coming down as in the market, but slowly but surely that's weaning away, still with it expected to come down. The question that was proposed, and I wanted to add that in there, is do we expect a real estate devaluation either happen or now or in the future, kind of like we've seen automobile values coming down? Do we have an opinion on that in the real estate sector?
I'll throw my opinion out there. And actually, Craig, this echoes something you had told us a long time ago, or a while ago, not a long time ago. Is one of the concerns I have is if we start to see that supply and demand issue start to fix itself, then we would potentially start to see those home prices come down a little bit as supply increases. Normal supply and demand consensus. However, if we start to see mortgage rates come down quickly, will we start to see demand increase faster than the number of houses that are available to hit the market? And will that then drive those home prices back upwards? So I think it's going to be a true supply and demand equation as to when will we start to see those home prices come down in comparison to when will those interest rates start to come down. I would love for home prices to come down personally. I just don't see it in the short term over throughout the rest of the year.
Yeah, that's a great answer. And I was thinking the same thing. It's supply and demand, and there's so many people on the sidelines right now just looking for homes and waiting for rates to fall or home prices to come down. As soon as something turns, I feel like they're just going to jump right on it, and that's going to drive prices right back up. So I'm not pessimistic on the real estate market, like I am on the auto market.
Yeah, we still do have a lot of demand and a shortfall in that world. So excellent. I really appreciate that.
Yeah.
All right, just a little wrap up on things here. Thank you to everybody attending. Again, this video is going to be on our YouTube channel. It's a hard one for me to say, on our website to be shared and we can send. If you are a client of McQueen Financial, please don't hesitate to reach out to your advisor for a copy of that, and they can help either send or direct that to you as well. And if you're a prospective client, please reach out to us. We can help and assist and get that over to you as well. I also want to highlight, we do have Investments 201, and I'm guessing for the attendees today, it's going to be very appropriate to take that next step into 201. That's going to be on May 22. It's going to be an hour long. It's going to take all of the concepts we talked about today, but take it to a little bit higher level for you. And please, I just also want to emphasize, you're not limited on who attends or the number of people that attend from your organization. So please share with them. They're welcome to attend and have today's video as well. Alicia, Bradley, Zach Brown, thank you for your expertise today. You guys did an excellent job. You shared a lot of great wisdom and thoughts with everybody here. And I want to just say thank you to you guys as well.
Absolutely. It was my pleasure.
Yeah, thanks for having me.
Yep. And all of our attendees, thanks for attending. Hope you guys have a great rest of your day and look forward to seeing you guys on our next webinar.